Yo, what up, and welcome back to Pnoid News. Man, listen, all right, I'm here with my boy TKMAO. All right, so he has, you know what I'm saying, handed motherfucking me this article and paid me to motherfucking do it. By the way, if you want to pay me, the Streamlabs link is in the motherfucking description. You want to pay me to cover something, pay me to do something. You know, man, I'm a whore for this money, son. You know what I mean? Like, yo, I don't mind putting my legs up and getting it done. Like, that's just how this operates, right? But like the name of this article is "The Value of Nothing: Capital versus Growth" by Julius Klein. Right. It is from American Affairs. It's just some economic shit. So like, if y'all boys, you know what I'm saying, like, you know, if y'all ain't down for the mechanism, yo, click off this motherfucker right now because this is gonna be heavy duty, and we're gonna be breaking as we go through because, like, I'm gonna be honest with you, this is a lot of technical terms for some very simple shit that we all kind of inherently know. All right, but like, you know, it's going to give you the technical valuation of it. TK, you there, my nigga?
Yeah, I'm here.
All right, I'm gonna get started on this article because like this is a motherfucking long one. I'll be honest with you. You know what I mean? This shit. I didn't get to the bottom of it reading it. You know what I mean? I got like halfway through. I was like, all right, bro. Like, yo, we'll fucking let's get this. Let's do this together. You know what I mean? All right. So, throughout 2021, U.S. stock market valuations have hovered near all-time highs. In June, the adjusted price-to-earnings (PE) ratio, the S&P 500 index, eclipsed the tech boom record of 2000. Many other asset classes have attained or nearly attained record valuations as well. Stratospheric valuations may be partially attributable to the unique circumstances surrounding COVID-19, as depressed trailing earnings combined with optimism about a rebound can inflate simple valuation metrics. But valuations were already high before COVID. The typical adjusted PE ratio has remained above the 1929 levels for much of the last few years and is also approaching the peak of 2000. Indeed, with the exception of intermediate aftermath of the 2008-2009 crash, valuations have remained at elevated levels since 2000 relative to previous history, despite the fact that this period has been characterized by a financial crisis, weak productivity gains, and ongoing narratives of secular stagnation. So, my brother, like, yo, you want to explain to them, like, basically what they're saying here?
All right, so very, very basic language here. The price to earnings ratio is basically the stock value of a company divided by the actual amount of actual money that they make. And since the year 2000, that number has been basically sky high.
Like, for
And
instance, right
that's
now,
despite the
Tesla,
fact.
like, Tesla at the moment is trading at a 335 times multiple. Right. And if like, so to give you a basic understanding, a company like Walmart trades around like 12 or 13. A company like GM or Ford will trade around, you know what I'm saying, like a 14 or 15. Right. 335 is fucking insane. Right. That means literally like for your company to be able to like get to the point where like the stock would actually be, you know what I mean, valued at how much the company makes, you'd have to grow 300, like, what is it, three, what would it be, like 30,000 times? Something like that.
Something like that.
You know what I mean? Because it wouldn't be 300, right? You know what I mean? Because if you grew it like 300, that'd be like 300%, right? I think that's, yeah, no, the company would have to grow 300 times, yeah, 300 times the size that it is right now in its actual earnings. Right. And that's an insane number, right? You know, I mean, that's fucking goddamn bananas. It doesn't make any motherfucking sense at all. So that's kind of the mentality of where this is. A lot of these tech companies, this is like a second tech boom, a tech bubble that, you know what I mean, kind of is just completely off the fucking wall and shit. You know what I mean? Right?
Uh, yeah, also for reference, I think Warren Buffett likes to buy companies that are under 5 for the PE ratio, which we haven't seen in a while.
Yeah, we haven't seen that in motherfucking forever. You know what I mean? Right. So it is what it is. So I mean that's kind of where the mentality is as far as shit's concerned. So like this is, you know what I mean, kind of motherfucking like things have been really really bananas for a while. You know what I mean, right? So that's kind of where we're at the moment.
Yeah.
All right.
I'll take over.
All right, go ahead.
The the conventional explanation for this prolonged period of high and rising valuations focuses on low interest rates and other accommodative measures taken by the Federal Reserve. Fed policy is undoubtedly a major factor contributing to high asset values, but intense debates over monetary policy have arguably overstated its importance. After all, Japan has implemented even more ambitious monetary policies in recent years, including negative interest rates, yield curve control, and central bank purchases of equities. Yet the Japanese stock market valuations are relatively low. The European Central Bank has also maintained low prices, and many European sovereign yields are lower than US Treasury yields. But European equity valuations are not as high. A more comprehensive explanation would simply state that the US economy is, to a unique extent, organized around around maximizing asset values and returns on capital independently of growth in terms of corporate behavior, financial market incentives, and government central bank policy. This may seem obvious or even tautological. What is capitalism if not a system aimed at maximizing returns in capital? But the disconnect that has emerged between returns on US financial assets and the underlying economic performance and even corporate profits over the last few decades should raise deeper questions about sorry, about basic economic policy assumptions and their theoretical foundations. Insofar as rising asset values are not linked with growth or productivity, and at the very least, it is clear that they can diverge for meaningful lengths of time, then not only are different policy approaches required to achieve these distinct objectives, but the larger relationship between capitalism and development will need to be rethought.
I
Now,
don't think they're wrong about that.
I right, because and we'll get into some details here later, especially when they get into IBM.
Yeah.
Um,
That was the part I was
but
like, all right. I need to hit up TKMAO because like, yo, I'm gonna need somebody here to like fucking like bounce some shit back and forth off of because like it doesn't make any motherfucking sense. Like, you know what I mean? Like what we're doing right now versus like what reality is as far as sense really concerned. You know what I mean?
I 100% agree with you. But like a lot of this, uh, people don't like, and I know this is going to sound really, really weird coming from a math guy like me, but people don't really check to make sure that their ideologies actually reflect reality for a disturbing amount of time. Like, you have to get slapped in the dick before you actually take a look at yourself and ask, is this actually working? And unfortunately, it looks like the previous generation here, when they got slapped in the dick, they just kind of doubled down.
Well, like, yeah, they really did because, like, instead of like standing here, you know, what I mean, continuing with like the ideology of like, hey, we're gonna have, you know, what I'm saying, fucking interest rates at a nominal rate, and you know, continue to like, you know, just do what we do. They dropped interest rates to like fucking near zero and just kept them there, right? Instead of like fixing anything at all, they were like, "Fuck it, we'll just throw more capital into the system and just, you know, what I mean, keep fucking this goddamn train a rolling." You know, what I mean, because and it didn't make any fucking sense at all. And we're gonna get into this like a whole lot deeper because like there's a lot of this that has to do with a lot of policies that I talk about on a regular basis in my mentality of mercantilism. You know what I mean, in like the modern sense. You know, and like when I get down like the Friedrich list and, you know, I mean, guys like John Maynard Keynes and, you know, I mean, fucking people of this nature. And even when we start talking about guys like Mencius Moldbug, who it's something instinctively that all of us understand, but like none of us are able to put in this article really does like help you just kind of explain it as a whole. And, you know, I mean, we can sit here and have this type of conversation. But all right, I'll take over from here. All right. Market returns inversely correlated with growth. Contrary to the conventional belief that stock market returns go hand in hand with economic growth, empirical studies have long shown otherwise. Analyzing data across 16 countries, including the United States, J.R. Ritter found that GDP growth and stock market performance were negatively correlated. Similarly, a recent National Bureau of Economics research working paper concluded from 1989 to 2017, 34 trillion of real equity wealth was created by the U.S. corporate sector. We estimate that 44 of this was an increase attributed to a reallocation of rewards to shareholders in the decelerating economy, primarily at the expense of labor compensation. Economic growth accounted for just 25%, followed by a lower risk price and lower interest rates. The period, there we go. The period of 1952 to 1988 experienced less than 1/3 of the growth in the market equity, but the economic growth accounted for more than 100% of it. In other words, the link between equity appreciation.
Wait.
What up? What up?
Let's just say that 100% here. We estimate that 44% of this increase was primarily primarily at the expense of labor compensation. That means almost half of this real equity growth was from not paying us more. And that is more than lower price risk and lower interest rates combined.
Yeah. Well, it's not just that. Well, economic growth accounted for just 25%, followed by a lower risk price of 18%. So, economic growth, as far as I think they're putting it, is actual like productive and like goods produced inside of the economy, and fucking lower risk price, which is the amount of like what would that be as far as shit's concerned? Like fucking the amount of like fucking need for the amount of price of goods to be able to produce something. Is that it, TK?
A lower risk price would just be like, I don't want to say insurance, but a lot of that is something like low risk price and lower interest rates you can both attribute to the Fed, because the more likely the Fed is to bail out companies, the lower the risk price is.
Okay. Right. So, like the period of 1952 to 1988 experienced less than 1/3 of the growth in a market equity, but the economic growth accounted for more than 100% of it. Right. That's, that's kind of the difference. It's kind of the thing. Like, so, it was more along the lines like most of those gains actually went to GDP, actually went to people's pockets, actually went to, like the nation really actually growing and, gaining the ability to like buy nominal more goods, right?
Like, so it was actual economic growth in the sense that most people understand it, as opposed to numbers going up.
Okay. Gotcha. All right. So, in other words, the link between equity appreciation and economic growth has been weakened in two areas. First, the labor's declining share of profits means that corporations can grow earnings even in a decelerating economy. Second, changes in valuation multiples can have a large impact on equity returns independent of any changes in earnings or overall economic growth. As I will argue, firm strategies to maximize valuations contribute to declines in labor's share of profits as well. All right. So, in other words, the link between equity appreciation and economic growth has been weakened in two areas. Labor's declining share of profits. Well, in my head, I'm sitting here going like, so if you have to hire more people, right? Is it the fact? Is it all right? So like I know because productivity went up like what was it like fucking like 150%, whereas like the regular fucking earnings only went up like 40 or 50%, something like that since the 1950s, right?
Right. Yeah,
And
so, that ballpark.
yeah, like part of this, a lot of this was the fact that they were bringing in motherfucking migrants and shit to do the work. But the second half was the offshoring and the automation of jobs. You know what I mean? So like the productivity went up, but like individuals didn't have the ability to stand here and actually enjoy those productivity gains. Right. It's kind of the mentality. All right. So, although the expansion of valuation multiples has attracted comparatively little attention outside monetary policy discussions, changes in valuations go beyond interest rates and are often inversely correlated with overall growth. For instance, when capital is being allocated to greenfield growth projects, less is available for share buybacks or other cash returns to shareholders, removing near term support for valuations. Even if incomes are rising and credit is expanding, businesses and households may be liquidating tradable assets in order to invest in more speculative and less liquid projects, depressing multiples on average. You want to break that down, my brother?
Okay, so the basic idea is that, like, you can have the asset valuations go down even if you are having actual economic expansion happen, right? And that's because what will happen is if for example, um I've got a house and I've got it paid off, right? I don't have a mortgage. I'm cool. But my neighbor is opening up like a lumber business, and he needs somebody to help get him off the ground as far as getting the mill set up and that type of thing. He will probably come to me, the local bank, everybody else in the neighborhood, and asks, "Hey, can you chip in on this? Because bringing in money here is going to help you out." And so what happens is if I get a mortgage, that decreases the valuation of my property because then I have a loan out against it. So anytime you have actual economic growth happening, what will happen is everybody will see that growth and leverage everything they have at the hilt in order to take advantage of that growth. And that actually drives down the valuation multiples.
Gotcha. Gotcha. All right. All right. So here's where we start really getting into this right here. So conversely, a corporate sector dominated by institutional asset members and executives whose compensation is based on near-term equity returns is highly incentivized to engage in activities included to expand valuations even if there is no impact or a negative impact on earnings. Such strategies include spin-offs that aim to unlock value simply by isolating business units expected to trade at higher valuations, or other forms of financial engineering like stock buybacks. At Apple, America's largest company by market capitalization, operating income has barely changed in the last 6 years. Yet its stock price has more than quadrupled in part due to the 337 billion dollars in buybacks. At the extreme, such behavior can harm growth by eroding a company's long-term potential to generate earnings. Monopolies, certainly a strong presence in America's concentrated economy, also tend to attract high valuations while harming overall growth. So this one here, like I get, like completely, right? So like the mentality is that Apple's been buying back its own stock to sit here and be able to drive up its valuation instead of, you know what I mean, like creating products that actually contribute to, you know what I mean, the actual company itself. Like it's not investing in hard, you know what I mean, like real productive assets and shit. What it's doing is it's just buying back its own shares and manipulating the motherfucking stock price. That's kind of the mentality.
Yeah, that is it put succinctly.
Beautiful, beautiful, beautiful. All right. You want to read something?
Sure. Furthermore, during the last few decades, the U.S. economy has experienced a larger shift away from capital intensive business activities, e.g., manufacturing, towards capital light sectors, for example, software and other forms of intellectual property. Asset light businesses generally command higher valuations even if earnings or cash flows do not increase because they avoid high capital expenditures needed to maintain physical assets. Because they can often expand without large incremental capital investments, and because they likely have more flexible cost structures in downturns, which basically means that if you're running everything as a server farm, you can easily just buy more server space and rent that as opposed to having to buy like a new lathe, a new CNC machine, this type of thing,
A new
because
press.
all of those are like,
Like
Right.
you don't have to have a
Because
factory. You know, you ain't got to worry about like maintaining motherfucking roads or worried about maintaining parking lots. And I talk about this when I talk about non-asset based reallocations, right? So anybody who doesn't understand what that means, it's a very technical goddamn corporate term. Basically means that what they want to do is they don't. All right, so like a company from say Europe, right, wants to fucking open a business here and open like a shop here. Basically what they do is they'll lease out a building from somebody, right? They'll have like one of their employees there. They'll hire like fucking, you know, an entire warehouse full of temps, right? They'll rent all the motherfucking equipment and shit. And then they'll sit here and fucking hire guys to do, or they'll hire a company to do the fucking yard work, and then or the fucking like the work to move the trailers around the yard. And then they'll hire security forces, right? Which are another company. And basically none of these individuals are actually employees of theirs that they have to worry about liability for, fucking workers' comp, or paying taxes for, or, you know what I mean, like their fucking human resources debt, right? They don't have to worry about any of this shit because, like, yo, they are not actually attached to these motherfuckers as far as shit's really concerned. It's not them. It's not their fucking company. It's not their employees, right? And they can write it all off at the end of the year because of the fact that basically you're just hiring a fucking consultancy. You're hiring a fucking outside firm to do the work for you. And that's what businesses have been doing, like, by and large, throughout the motherfucking economy, to be able to not have to fucking actually, like, fucking deal with paying taxes. And that's kind of the mentality. Am I wrong?
it's not just taxes, it's also valuations, where what they're trying to do is they're trying to make like it, just for an example here, if you're talking like a machine shop, they want to make just the engineering side its own company, because just the engineering side is going to have a much higher stock multiple than the whole machine shop, and that's going to make the entire operation more profitable from a shareholder's perspective.
Okay. Got you. Got you. Right. All right. So, you know what I mean? Like, we're going to get into that more here, you know what I mean, here in a little bit, fucking, as far as shit's concerned, because, like, they actually give examples of this happening inside of it. All right. The contrast between S&P 500 PE ratios and free
Yeah.
cash flow yields as a metric which includes capital expenditures and other items that not appear in earnings is revealing. Although free cash flow yields have dropped significantly in 2021 to levels indicative of historically high valuations, they remain relatively high for most of the period since the financial crisis. The unusual combination of high earnings multiples and high free cash flow yields is consistent with the shift of earnings to asset-light businesses, as well as weak capital and investment more broadly, which in fact has been observed throughout this period. It also suggests that the growth prospects low and cash returns to shareholders growing in importance. Most stocks are increasingly trading like bonds. So explain that one to me, because like that's some more technical shit that I kind of, you know what I mean, don't really get.
Okay, so basically what's going on here is that most bonds are traded how can I say this exactly? Most bonds are backed by assets very weakly, right? Whereas stocks are supposed to represent an actual business, bonds are supposed to represent a promise to either repay a certain amount of money every year through a dividend, or to simply just go up in value. And so what's going on here is that are most stocks are being traded like bonds because they've got a very low amount of dividends getting paid out, much like bonds are do, because bonds are considered a very safe asset. That's why they have very low yields. However, they have high prices. So stocks are being traded like bonds because they have very low yields and very high prices.
Okay.
Does that make sense?
Gotcha. All right, makes way more sense and shit. All right. So, in
Okay.
addition to consider
An
and
additional consider
go ahead, man. Go ahead.
all right. An additional consideration is international capital flows. America's trade deficit, which is not unrelated to its offshoring of capital and labor intensive sectors, must be offset by foreign capital flows. These inflows adds further support to asset valuations. In sum, there are many factors that can cause asset valuations and economic growth to diverge. These factors appear in varying degrees around the world, but seem to be especially potent in the United States, where their maximization has been systematically embraced as a business strategy. So what he's saying there at the end is that, well, into this section, is that US businesses have been maximizing shareholder value as a business strategy, because if you make your shares go up, you can then sell those shares in order to support the actual business. This is why Uber and Lyft and these types of things, they lose money on every transaction, but they make it up in volume because they've got such a large user base that the market just thinks that's valuable, and so they throw money at them.
That's fucking awesome. Legit. All right. yo, yo, this market's completely and utterly garbage. All right. Shareholder value versus profits, the inadequacy of economic theory. Of asset valuations from underlying economic performance is perhaps the most conspicuous feature of the U.S. economy in recent decades. Yes, most economists and policymakers have failed to appreciate its significance. They refuse to ask a simple question: what if, instead of asset valuations and growth necessarily moving together, firms are being managed to maximize asset valuations separately, or even at the risk of growth, productivity, and other socially benefited objectives? Academic and policy discourse in particular tends to assure that the growth of asset values is straightforwardly driven by the growth revenues and profits. This way of thinking is at least as old as Adam Smith's descriptions of the invisible hands. As every individual therefore endeavors as much as he can both to employ his capital in the support of domestic industry, and so to direct that industry and its produce may be of this greatest value, every individual necessary labors to render the annual revenue of society as great as he can, by directing that industry in such manner as its produce may be the greatest value he intends. Only his gain and he is in this, as in many other cases, led by the invisible hand to promote an end which is in no part his intention. Okay, so this is where like my mercantilist little mentality comes in. The problem is there's twofold. One is, you know what I'm saying, you can't have a nation of 350 million fucking people that is as large and as vast as ours. Motherfuck, too many fucking companies get lost in the fucking fray, and when they do, by the time you catch them, you know what I mean, they end up being entirely too big for you to fuck them up. Number one. And number two, when you untie these companies from the nation itself, and from the country itself, and from its workers, you end up having this issue of individuals getting to the point where they really don't give a fuck whether or not, you know what I'm saying, like the society fucking exist in is any fucking they don't give a shit about the society it exists in. They give a shit about profits. And if they can use labor from outside of the country to build some shit, or to fucking, you know what I mean, be productive for their company, and not give any of these benefits to you know what I mean, like the people themselves, through, you know what I mean, like labor, or through, you know what I'm saying, investment in, you know what I mean, fucking manufacturing in the local area, then they are not going to. They're just going to say fuck you and just make as much money as possible, which will drive up fucking, you know what I mean, asset valuations or equity valuations, but it's not really going to help the country as a whole. Is that kind of where we are?
Yeah, yeah, and what he's pointing out here is that it is assumed in most academic literature, and be that Austrian or libertarian, and he directly quotes Adam Smith here, which is why that entire section you just read was a mouthful and really weirdly constructed, because Adam Smith was an Irishman, that means he was probably drunk the entire time he wrote that.
Well, that and the fact that it was like what 400, 500 fucking years ago doesn't help either. You know what I mean?
Right. Little column A, little column B. But basically, what he's pointing out is that at no point in time did anyone who's forming most of these economic theories think about the idea that, like, a company doing well that was a part of a nation would end up actually hurting the overall economy of that nation. Like,
Well, no, no,
for
no. I mean,
example,
like
here,
they never. He never
go for
thought.
it.
He never had the ideology that individuals would be able to have massive amounts of manufacturing based. You know what I mean? Like, like what is it? Your average iPhone's created in like fucking 65 different countries or some shit like that. Ain't that what it is?
Yeah, close to that. Yeah.
Right? Like they never had a thought that like fucking, you know what I mean, like a manufacturing supply chain would be that vast. You know what I mean?
Yeah. Yeah. And so they just assumed that anytime you sell something, you've got to employ local workers. When, we've got Amazon now, where I've got a friend, and if you're listening to me, do what I said. He doesn't want to get his supplements through the local supplement store because it's like $5 more expensive, when that $5 means that he has access to a dude who has a nutritionist degree. So he can just ask them, okay, will this, and this work for me? Is this sane? And he can employ someone and keep the property values up in his local community by just spending a little bit more a month on whatever bullshit supplements he's getting. But no, he wants to buy it through Amazon.
Well, like, all right, so I mean, that's not wrong. You know what I mean? Like what you're saying. Like, me personally, I go out of my way to use local businesses. You know what I mean? Like, I had to go and buy filters for my fucking my furnace, right? And when I had to go buy these filters for my furnace, like I went to Appalachian Hardware, right? Legit, that's what it's called. It's called Appalachian Hardware. You know what I mean? And like I go there, why? Because like they employ Americans. They're by Americans, and literally like the fucking parent company is True Value, who or True Temper, which Ames. It used to be Ames, and now it's Ames True Temper, and it's True Value, right? Which is a company that literally employs Americans making American goods in America. You know what I mean? And I think that's of the utmost importance. You know what I mean? Is fucking doing these type of things. You know what I mean?
Yeah, there's that, and there's also the fact that, like, if you shop in your community, then you're being a member of the fucking community, which I feel like is something that we've really lost.
Well, this is shit that I speak on all the time. You know what I mean? This is shit that I bring up constantly. It's like, you know what I mean? Like, yo, buy American, buy American, buy American, buy American. You know what I mean? And motherfuckers is like, why would I buy American? I can get a Japanese car, you know, and it lasts like twice as long and it's just as better. And then I'm like, yo, but the fucking, it's not an American company, dummy. I mean, like, all their profits are shipped back to fucking Japan, stupid. You know what I mean? Like, yo, you want to be able to have those profits in America. You want to employ American workers. You want American manufacturing. You want American. It's about American parts makers. It's not just about the American union workers who are getting $38 an hour for a lug nut or whatever, right? Yo, it's about like the fucking guys who are making, you know what I mean, the fucking springs for it, and the guys who are making the bolts, and the guys who are making, you know what I mean, the fucking motors and shit, like in the tires and all these type of things. You want American fucking workers to make your American fucking car. You don't want, you know what I'm saying, like fucking Japanese people or Chinese people making your fucking parts. Like, that's an important part of this that people just don't seem to fucking grasp. Like, they're just fucking lost because they're like, I don't understand why it's so important, you know what I mean, to fucking stand here and support our own fucking people, right? And they're fucking, like, Americans have been just, they're fucking retarded. I don't know. Anyway, you want to read the next paragraph?
Next breath, they're like, yeah, but in the next breath, they're also like, I don't know, why is it a problem that we can't get everything through our ports, and like a fifth of everything rots before it actually gets sorted out by the dock workers. I don't know. Anyhow, today, however, any discussion of maximizing the value of production and the annual revenue of society sounds almost as quaint as capitalists actually naturally preferring to support domestic industry. Corporations instead seek to maximize returns to shareholders, which practically means maximizing the value of the firm's equity. And increasing profits is at best a means to that end. While deploying capital to grow revenues and profits may be the most intuitive way to increase equity values, it is hardly the only one. Rather than take the risks involving in expanding operations or developing a new product, it is often easier for firms to simply reposition or financially re-engineer themselves to realize a higher valuation. Consider, for example, the case of IBM, which plans to spin off its IT infrastructure division this year in order to focus on high margin cloud computing. The move is being cheered on by Wall Street because it is believed that the two businesses will be worth more as separate entities than as one. In particular, the remaining IBM cloud business should command a higher multiple once freed from the lower margin, slower growing divisions. IBM has followed this same playbook for years. We divested networking back in the 90s. We divested PCs back in the 2000s. We divested semiconductors about 5 years ago, said IBM CEO explaining the spinoff. As a result of this strategy, IBM's revenues and net earnings are lower today than they were in 1998, but its stock price and PE ratio are higher. Notably, the company has also spent far more on stock repurchases than on any other investment in its ever shifting core business during this period, undercutting the stated rationale for these divestments. So, was this the part that was fucking you up, or is it the next part?
Well, like, this is the part right here where like I was like, all right, bro, you know what I'm saying? Like, I need to drag TKMAO in here. It's not so much that like I'm fucked up by it, but like, this is like, like, all right, you know what I mean? Like, this is well worth doing. It's kind of the mentality, right? Because
All
like,
right.
like,
So,
so this is the mental that they would much rather, like, Wall Street would much rather invest in a company, and a company becomes more valuable when it doesn't have hard assets at all, right? It becomes more valuable as like a company's more like the cloud computing of IBM is more valuable than the actual computing or the actual like fucking like processor manufacturer.
yes.
Like that doesn't
Yeah,
make any fucking sense whatsoever. That's fucking retarded.
right. Because the actual semiconductor production, and by the way, uh, those of you who can't get any chips for your gaming computers or pickup trucks or whatever, like, this is the reason why we're not making them here. It's because we keep spinning off all of the companies that make them, and then we ship them overseas. Because over there, you can get a bunch of incentives for building semiconductors over in their country, and you can get the added benefit of much, much lower wages, right? And also, largely, you don't have to worry about like the
And
uh,
lower
environmental impacts.
yeah, and lower cost of, you know what I'm saying, property, lower cost of, you know what I'm saying, fucking goods, a lower cost of pretty much everything over in that neck of the woods as compared to here. You know what I mean? Like the cost of motherfucking like owning a fucking business or a warehouse or a factory over there is going to be way cheaper than it is here, and they're not really going to have to negotiate with some local municipality, which goes, well, like what's the impact going to be on the traffic? You know what I mean? What's the impact going to be as far as like fucking pollution and all that shit? As you said, with like the EPA factors, like that's an important part of this. That like I mean, I understand like we go like you're kind of you want to stand here and blame like the government and go, oh man, the government makes it impossible for you to be able to do shit. I'm like, yeah, but let's talk about this because these companies shouldn't be dumping just garbage in the motherfucking water and shit. You know what I mean? Like they shouldn't just be polluting your fucking local fucking town and like, you know what I mean, fucking up kids and putting cancerous fucking chemicals where your children play. You know what I mean? That's fucking important, right? You know what I mean? Like that's something that we should do. Like we should stop companies from doing that. And the fact that you're okay with them going overseas and doing it to other people is fucking dumb. Like it's psychopathic. You know what I mean?
Yeah, yeah. Most people don't realize that one of the main chemical treatments involved in silicon production as far as chips go is they use a lot, and I mean a lot, of hydrofluoric acid. And hydrofluoric acid is stuff that is so nasty that if you splash it on yourself, step one for treatment is amputation.
Jesus fucking Christ.
Yeah, it's not fun stuff. You do not want to fuck with it at all. Hydrofluoric acid is frightening. And it's used regularly in silicon manufacturing. So in places where either they have a high level of water recycling, like Taiwan, where like Taiwan is a small island, so they invest a shitload of money into like water purification in general. So they've got that tech on the cheap there naturally. Or in places like China where they just don't give a shit. It's a lot cheaper to do that there than to do it here where you got to make sure that you're not like poisoning the groundwater.
Right. I mean, like, and I said, you know, as I said, like, we shouldn't be like polluting the fucking groundwater. Like, it's important. You know what I mean? Like, you know, I'll be honest, I live in a place where coal manufacturing and steel manufacturing was normal for a lot of years, right? And even today, I know a lot of people who have coal-fired, you know what I'm saying, fucking furnaces in their basements and shit. And if you go up to these places, there are babies who are born, and by the time the kids are 5, like all of their teeth rot out of their fucking mouth and shit. And it's called blue baby syndrome. Basically, like fucking the calcium in your fucking bones and your fucking teeth and shit kind of just disintegrate and like become destroyed, and you end up handicapped due to the amount of motherfucking like mercury and chemicals inside of the fucking coal that leaches into the groundwater. You know, and this is something that, you know, like we should have a conversation about. You know what I mean? Like we should be going like, yeah, you can't just fucking doing this. You know what I mean? It's not fucking positive and shit. But we do it because of the fact that, you know what I mean, like, we fucking stand here and we bitch about, you know what I mean, like fucking the government trying to stop motherfuckers from polluting shit because, you know, fucking like we hear like these companies that buy advertising that have to manufacture here, they can't manufacture anywhere else, bitching about, you know what I mean, like fucking these, like, you know, they're going, oh, they're trying to save, you know what I'm saying, this one fucking frog that exists in this one place or whatever it is. And this one frog is standing in the way of fucking productivity and you getting cheaper prices on whatever the fuck it is they're selling to you. And the truth is that these companies don't want to pay for the workaround. You know what I mean? Like, you know, they don't want to stand here and look after your fucking community. They don't want to look after the native people or whoever it is. And like, you can have that conversation and say like, oh man, you know, like we need oil, you know what I mean, or we need whatever it is. But, you know what I mean, on the same point, like, yo, we need it safely. And that's not a fucking terrible thing. Legitimately, it's not like, yo, you motherfuckers are gonna want to be okay eventually. You know what I mean? Like, you're gonna want to be all right. But anyway, you know, like it is what it is. Anyway, so you know what I mean? If I can hear, I'll start this next one. The point here is not that all divestments are bad, that all integrated businesses are good. The case of IBM does demonstrate, however, that shareholder value maximization, whether in a single firm or the whole company, does not operate in a simplistic way theorists usually imagine. Today's shareholder-driven corporations are not necessarily or even primarily motivated to engage in traditional methods of growing a business. Companies are often highly incentivized to pursue financial engineering and valuation multiple expansion rather than investing to increase earnings. Eliminating profit streams can actually increase shareholders' returns when the remaining company trades at a higher valuation, especially as share buybacks or other cash return feature in the process. Like Adam Smith, most of the neoliberal economists, right, who promoted shareholder primacy and financialization took for granted that maximizing shareholder value meant maximizing profits and growth the old fashioned way. Milton Friedman's famous essay in support of shareholder primacy is titled The Social Responsibilities of Business is to Increase Its Profits. Friedman here did not even consider the possibilities that firms might prefer financial engineering strategies to increase shareholder values, strategies that avoid inherent risk and difficulties of growing profits. The business school professor Michael C. Jensen was far more sophisticated than economist Friedman, and he understood shareholder primacy more precise terms of maximizing total firm value. But Jensen still equated firm value with its long-term market value of the firm's stream of profits. He largely ignored the implications of the fact that markets value some streams of profits more highly than others. I'll break that down a little bit.
So basically, the market will value some types of profit more than others, right? Where if you're not having to invest in anything new, then and it's just like basically a rent check on whatever type of company you've got going on here, then it's going to be much more highly valued. Like the best returning asset in the last 20 years has been a tobacco company.
Really?
Like not yeah, yeah. As far as like averaging it out, because what's happened is the tobacco company hasn't like there's nothing they can really expand to. They've already got enough farmland and enough tobacco and all the equipment they need, so every year they just pay out dividends.
Well, like, all right, so here's where I see this shit. It's basically the premise of, you know what I mean, like a company that doesn't have any liabilities is valued far higher than a company that, you know what I'm saying, fucking does. Right? It's like, you know,
Right.
if your whole company is based off of, you know what I mean, cloud computing or, you know what I mean, server farms or whatever it is, you don't have to worry about being invested in fucking real estate, worry about being invested in motherfucking people. You don't have overhead costs as far as electricity or motherfucking anything of this nature. Like you're not affected by, you know what I'm saying, like a lot of the problems in the goddamn, you know, with the fucking market and shit. Which we're gonna get into here in a little bit as well. You know what I mean? But like I think that's kind of where the mentality is and shit. You know what I mean? So
Yeah, yeah, and it's also because like if you don't have a lot of costs, it's a lot easier to scale up and down as the market needs, right? Whereas if you've got a construction company and you no longer need 5 trucks to operate, like you've just got an extra truck now, and that's just an investment that you're not going to get a return on. As
gotcha.
opposed to if you're renting out server space, you can just reduce the number of servers you're renting and then you're good.
All right. So these issues are even more significant if somewhat less viable in firms' internal capital allocation decisions. In theory, firms should invest in a new product whenever the expected returns on the investment exceed the firm's cost of capital. In practice, however, firms have maintained hurdle rates that considerably above their cost of capital. Multiple studies have shown that hurdle rates typically exceed firm cost of capital by up to 7.5%. Moreover, hurdle rates have largely remained constant around 15% for decades, despite falling interest rates and thus lowered cost of capital in recent years. The fuck is a hurdle rate?
Okay, so the ideology here is that you would think that basically it's a hurdle rate is a premium on top of like the break even rate, right? Because what happens is anytime a company looks at a new project or a new investment or whatever, in theory, they should invest in it as soon as they see that the cost is lower than the amount of gain that they're going to get out of it, right? However, a hurdle rate is basically like a hurdle that the company has to get over in order to actually consider or go into making that investment. So, just as an example here, you would assume that a company that is just intent on growth would roll out a new line of products as soon as it can see that it can break even, because expanding the business and just like getting that extra volume would be worth it for no other reason from the fact that, you know, that's more revenue and more assets to trade against as far as their stock value goes. But what is happening here is that they have to be at a point where the potential gains is not just at the same cost of the amount of capital that they'd have to invest, but significantly more. And that is despite the fact that, like, even if they're just breaking even, the company is worth more because it's bigger, right? And so the hurdle rate is saying that basically a company that is investing, say, $100 into a project that will yield $100 actually needs that project to yield $115 before they even consider investing in it.
Okay. All right. I got what you're saying. I feel your mentality. And I think a lot of that might come from the fact that you have to invest in so much technology and there's a lot of overhead involved when it comes to the R&D at this point, just due to the fact of like how, you know, what I mean, like how far we've reached technologically. Is that kind of the mentality of that as far as creating products and shit's concerned?
That's part of it, but then there's also the thing where, like, you have to, the new investment doesn't just have to be worth the money, it has to be worth the money over just doing a stock buyback.
Okay, okay, I got your mentality there, right? But like, so, all right. I think yo, the cost of actually creating a new product in order to make a, you know, in order to like stand here and invest in a new product, you know, what I mean, it may actually end up costing more, you know, what I mean, to create that motherfucking product, just due to the fact that like advances on a regular basis are just tending to cost more as a whole, due to the fact that like we've come so goddamn far. You know what I mean? It's kind of the mental. Like kind of like all the low
Yeah, yeah.
hanging fruit has, you know what I mean, kind of already been picked.
Right, right, right. And that definitely could be a part of it, but I think the point that they're simply pointing out is not necessarily why this is happening, but rather that as an in general thing, companies are very, very reluctant to actually roll out anything new, and that is a new phenomenon. Like, Henry Ford would roll out new products before he even knew if they would be profitable.
No, 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 no. That's not true at all. Don't tell motherfuckers that shit. That's not true at all, man. Like yo, Henry Ford did
All right.
not want to put out new products ever. Like yo, they had to fight with Henry Ford to move on from the fucking Model A and the Model T. Like legit. Like they literally had to fucking like yo, they was damn near trying to get him the fuck out of the CEO seat, like as a whole, because like he refused to come out with new shit. He just wanted to keep running with that shit over and over and over again. That's all the fuck he wanted to do. Like 100%. Yo, Henry Ford hated creating new products. Like hated it with a fucking passion. You know what I mean? Like this is just like
All right.
fucking yeah, like yo, most and that goes as far as most all car companies legitimately hate creating new products. Like yo, they would much rather just stick to what works, right? It's like playing the hits with your favorite band. You know what I mean? Like, you ever go see like your favorite band in concert, right? You know what I mean? Like, you don't want to hear their fucking new album. You want to hear the shit that you like. You know what I mean? You want to hear them perform the stuff that you love. You know what I mean? They're playing the fucking hits. Like, that's the mentality that most companies have as far as shit's concerned. Other than tech companies. Tech companies is a whole different animal, like cell phone companies and shit. They always come out with new products and are expected to come out with new products because nobody wants to stand here and buy the old shit over again. Right? It's kind of counterintuitive as far as like the cars versus, you know what I'm saying, the whatchamacallits. But like the cars, like that's why like Ford right now actually is coming out. They're coming out with a 1950 Ford F100, right? 1956 Ford F152, something like that. But it's electric fucking Ford F100. They're just trying to get individuals accustomed to motherfucking like using new cars because their new Mustang that they came out with that they made all electric, everybody fucking hates it with a passion, right? It'd be different if like they literally like came out with a 1969 fucking Shelby GT 500, right? And it was like the same body as back in the day, and they're like, everybody's like, what? But it's electric. And you're like, I don't care, I'll take it, right? You know, that's kind of the mentality, right? You know, so like that's what they're doing. Like, but like, yo, they fucking hate coming out with new fucking cars because it's always a risk. Like, look at Pontiac with the Aztec, right? Like the Aztec today, if it came out today, everybody would love it to death because it's a crossover. Back in the day, though, it was way far ahead of its time, and like fucking nobody like it universally was hated. You know what I'm saying? That's kind of the mentality in the car industry. Sorry, man, I had to nerd out for a second. I apologize, my brother.
No, like if I say something dumb, you gotta call me out on it.
I'm sorry, my brother.
Especially on this type of shit.
Right? I apologize. And my nigga like, yo, we start talking cars and shit, nigga like, yo, my dick gets hard and whatnot. You know what I mean? Like, yo, all right.
Yeah, but or rather, I should say, current economic theory dictates as soon as it is profitable to do so, you should come out with a new product. That's obviously not what ends up happening, and that's what they're describing here, where you have to have like a lot of money just sitting on the table before they'll think about changing stuff up.
Yeah. You know what I mean? Again, like the only place that doesn't work is literally like the fucking tech industry. Right. Because motherfuckers always want a better, newer laptop. You know what I mean? Like, you know, like if you have a 4 GB laptop and they come out with a 32 GB laptop, you know what I mean? And it's affordable, like, yo, motherfuckers will go and fucking buy that shit because it's going to be better. Like, everybody knows every time they come out with new tech, it's usually always better. Cars are just not that way. Because cars are cars, you know what I mean? Like, there's a reason why, like, the BMWs and shit and Mercedes, have you ever heard of them coming out with a new BMW or a Mercedes model?
Why would they?
That's kind of the point. Right? Like, yo, and if they did come out with something new, motherfuckers would go, I don't really want that. Every time they come out with a new Porsche, it's, fuck that shit. You know what I mean? Ferraris are hit or miss. Lamborghinis are hit or miss. Same type of thing. You know what I mean? It's always that way. But anyways, let's keep going. From the standpoint of economic theory, this represents an irrational refusal to maximize profits. But with regard to maximizing equity value, it is an eminently rational strategy. Lowering hurdle rates would mean investing in projects that might increase earnings, but which would likely degrade earnings quality. In other words, metrics like return on assets would deteriorate and valuation multiples would probably fall. Avoiding such investments and instead returning the cash for shareholders to further prop up valuations becomes a preferable approach to maximizing shareholder value, even if it forgoes substantial profit opportunities. But if the link between shareholder value and profits is severed, then the justification for shareholder primacy and much else in economic theory collapse. Yo, you want to break it down just a little bit, man? Just a little bit.
Okay. So basically, the idea is that a company doesn't necessarily just want to make more money, right? And even if it's profitable, what they want is they want a maximum return on investment. And so that means that they are not going to invest in something like you were saying there, where even if it brings in more money and more profit, if that is it, like, just as an example, if you've got a machine that is pumping out parts that is giving you like a 10 to 1 ROI, just as an example here, where it's like pumping out washers or whatever the fuck. Um, and you have the option to buy another machine to pump out nuts, but that's going to be like a 5 to 1 ROI. It is not worth it to that company to buy that new machine just because that would make their average return on investment like 7.5 instead of 10. And that means that they can't sell their stock for as much. So it's less valuable to actual investors to have a integrated company, which is why you have these things like Ford and all of these other companies where they they hire out all their chip manufacturing, and that makes them extremely profitable because they don't have to have a silicone fab, even though, like, you can't tell me that Ford couldn't pay Intel to build them a fab just to build their chips here in America. Now, they're not going to make the same kind of profit on those chips as they would if they just bought them out of the bargain bin from TSMC. But what would happen is it would be a much more resilient business. It would have, like, from top to bottom covered as far as supply chains. They would control everything, so they would make sure that everything fit together and actually worked. But that does not mean that the company would be as highly valued, because you can't say for every dollar that you put in, you get $10 out.
Okay. All right. I like that. I like that mentality. All right. So Nikeification, right? Lawrence Summers, representing what might be called the neoliberal economics establishment, has resisted these conclusions. Summers agrees that the decline of investment and stagnation of growth and productivity are major problems in the United States. Nor does he dispute or even discuss the widening gap between corporate hurdle rates and the cost of capital. He simply argues that these issues are not attributable to shareholder primacy and corporate short-termism. In a sense, Summers is right. Notions like the short-termism imply that these issues are merely behavioral and not structural or in nature. All right, and the separation of assets, values from profits and growth, though they may be added by the logic of shareholder primacy, goes beyond any specific corporate regime. It is embedded in the firm's operational strategies. Thus, the arguments that Summers adduces in defense of typical firm behavior actually point toward an even more radical critique of contemporary economic arrangements. Summers argues, for instance, that if the shareholder primacy were the principal problem, then phenomena like the underinvestment would be most pronounced in publicly traded corporations, which are the most vulnerable to shareholder activism. In fact, however, the same trends are observed outside of publicly listed companies. Yet this does not prove that financial market pressures are not affecting the public firm's operations. It merely indicates that many privately held firms are subject to the same pressures. This should not be surprising given the dominance of institutional private equity firms, which are equally reliant and motivated to pursue strategies to achieve investment-less growth, to borrow a coinage of German Gutierrez and Thomas Philippon, as well as growth asset value maximization. This indeed what empirical analysis of private equity portfolios reveals. A recent Bain report calculated that half of the value created by private equity since the financial crisis was driven by multiple expansions. Another study found that 54% of private equity transactions revenue growth slowed, and 45% margins contracted, and 55% capital expenditures as a percentage of sales declined. Like, what the fuck? Hang on, let me read that again, man, because I didn't get that. All right, so this indeed what empirical analysis of private equity portfolio reveals. A recent Bain report calculated that half of the value created by private equity since the financial crisis was driven by multiple expansion. All right, another study found that 54% of private equity transactions revenue slowed in 50 around Revenue growth slowed, and 45% margins contracted, and 55% capital expenditures as a percentage of sales declined. All right, explain this. Wait a minute. And then 55% capital expenditures as capital sales declined. So, all right, explain this part to me, man, because this is fucking me up right now as far as like these numbers are concerned.
Okay, they definitely worded it a little bit weirdly. So, Bain Financial is a
Yeah, I know. Bain. That's Mitt
it's
Romney's
a
joint. That was Mitt Romney's company and shit back in the day.
right. But what they found was that half of the economic value, which it was created since the financial crisis, which was that's the academic term used for like the 2007 to 2009 like housing bubble popping, right? Um, so half of the value that has been created since that time in a lot of these portfolios has been created by value multiples expansion. So this would be like things doing a Tesla here, where you buy a Tesla, a stock of Tesla, right? And it's valued at like 100 times price to earnings, right? And then it goes up to like 200 times price to earnings. And that's where half of the value comes from private equity portfolios since 2008. Just
Okay, so like explain the capital
stuff
expenditures.
moonshotting.
Explain the capital
Uh,
expenditures as a percentage of sales declined. What the fuck
okay,
is that?
so capital expenditure is like the money that you would spend on getting like new assets for your company. So, for example, that's talking about like if you get say $100 in sales revenue, right? And you spend $50 on like the actual capital to maintain the business, whether it's maintaining a lathe or something like that, or you're getting a new machine, or you're getting a new truck, this type of thing. Uh, in 55% of these businesses, right? The amount of money that they are spending putting back into the business as far as hardware goes, as far as actually growing the physical infrastructure of the business, has declined as a percentage of the amount of money that they're getting in.
Okay.
Right. So now, the way they did it this way was to kind of make it industry agnostic, because like some industries naturally have to put in a lot of their sales money back into like the business, right? Whereas others, they have to put much less in. However, if you just make it as a percentage of sales, you control for that factor, and you see that it's as an overall trend, more than half the companies are spending less on investing in the company from, whatever amount of money they're making.
Okay. Okay. All right. Okay, I got the mentality now. All right, yeah, it just wasn't making sense to me as like what the fuck they were talking about and shit. Like just that whole fucking sentence and shit. You know what I mean?
Yeah,
Okay.
there are a lot of semicolons that are completely unnecessary.
Like, it's like I mean sometimes I'm gonna get a busy signal like nigga I'm intelligent, but sometimes I'm just not that motherfucking intelligent. All right, similarly, Summers cites research showing that the greater shareholder power is associated with the stronger discipline of CEO pay. But Summers fails to acknowledge that the extensive body of research demonstrates that shareholder activism is also associated with declines in investment and operating cash flow, despite increases in capital returns. In other words, With or without activist pressure, whether publicly traded or privately held, firms are pursuing asset value maximization strategies that are often inconsistent with operational growth and conventional profit maximization. Regardless of whether management or shareholders are the primary beneficiaries, such an economy is very different from what economists imagine it to be. Terms like financial engineering can imply that any misaligned incentives are limited to firms' interactions with capital markets. In reality, it is the changes in the structure and operations of the corporate sector that are most significant. Gerald F. Davis has called his transformation Nikeification, after Nike's business model, which is based on outsourcing its apparel designs to contract manufacturers, mostly in Asia, through its strategy. Nike was able to isolate its intellectual property rents from the capital and labor costs of manufacturing, avoiding capital costs and reducing cyclicality in addition to labor tax and regulatory advantages offshoring achieved. The benefits of this strategy for firms and investors are obvious, and the most U.S. corporations have been reorganized along these lines. That any that resisted faced pressure from activist investors and private equity examples, how now include everything from fabless semiconductor companies to firms like Hilton Hotels, which today mostly owns and manages a brand portfolio, while private equity firms or REITs own the hotel real estate and operations are outsourced to third-party providers. Yeah, this is what I was saying about non-asset-based motherfucking allocations. This is exactly what I was saying about this shit. Legit. You know what I mean? That most of these companies don't even own the fucking property that like they're fucking, like if you think of like a Samsung warehouse or you think of like a fucking hotel, most of those hotels are literally, you can almost call them franchises. It's kind of the deal. Or like a fucking warehouse is kind of like a franchise at this point. You know what I mean?
Yeah, yeah, and like there are advantages to that kind of business model, like specifically as far as semiconductors go. The reason why TSMC has been able to do as well as it can, besides the fact that, like, I'm not even gonna lie, it gets a retarded amount of money from both Taiwan and China, and China's not even happy about the amount of money that is going into Taiwan to that company. It's just that it's a thing that happens because Chinese love dividend investing, and TSMC gives a retarded dividend. Um, and so, like, what happens is these companies that are like specialized to one particular part of an industry, they get really, really, really good at doing their one thing. And since they get really good at it, they get really efficient at it, which means that they don't have all these auxiliary parts of the business, which means that they need other companies to actually survive. However, that also means that like their stock price is going to be sky high because it is the bare minimum amount of money you can to make a business of this type.
Well, like, and I'd also like to touch on that shareholder activism thing, right? Where like shareholders will literally take companies to fuck the court to force them to, you know what I'm saying, like fucking maximize their goddamn fucking their share value rather than, you know what I mean, actually sit here and, you know what I mean, like run the business properly and grow the actual manufacturing or the production of the motherfucking business or, you know what I mean, invest in the business itself so that you end up becoming, you know what I'm saying, like, you know, fucking a better manufacturer. You know what I mean? It's kind of the deal. And most of these companies have moved to this model, you know what I mean, without even like, it's kind of like I don't know if you ever saw like the movie Shooter, fucking with Mark Wahlberg and shit. But like, there's this mentality that this dude goes. He said, "Look, you know what I'm saying. What you do is like when you fucking go into Africa and you want to like drill for oil or fucking mine or whatever it is, you know what I mean. Like you'll have fucking some local tribes start their bullshit, and what you do is you go through and you just fucking execute all those individuals in that tribe, so that the next tribe you go to, they don't have to be asked." You know what I mean? Like, yo, they're not going to fucking put up a fight because they seen the last one just get their fucking head caved in. It's kind of the mentality. You know what I mean?
Right, right. And it's also worth noting that like these shareholders, they want people, they want these companies to run efficiently. And I don't know how much you know about like the physical descriptions of like what makes a efficient or a robust system, but like as an in general thing, if you have something that is very, very efficient, that means that it is very, very fragile.
Yeah. Yeah. You know what I mean? It's like a motor. You know what I'm saying? Like, yo, once you get that motherfucker running at the very, 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 very top end of what it can do, you know what I mean? Like, it will sit here and, you know what I mean, like, be running like it's a very fragile fucking engine and shit. You know what I mean? Like, if like one bad thing goes, like the whole thing kind of fucking explodes. You know what I mean? As opposed to, like, say, like a diesel engine, which, you know what I mean, is not fucking super efficient. But, you know what I mean? Like, yo, it'll fucking be able to tolerate a whole hell of a lot of a beating. You know what I mean? It'll run fucking forever. Like, there's a reason why, like, a high mileage for a Ferrari or a Lamborghini is like 10 or 15,000 miles, and high mileage for a tractor trailer is like fucking, 2 million miles. It's a wholly different animal. You know what I mean?
I have seen tractor trailer. Sorry, I have seen like old tractors continue running after they got shot with a 50 cal.
Yeah, yeah. You know what I mean? Like, they're not super efficient, right? But like, goddamn, are they motherfucking tough? You know what I mean? But like a Ferrari, you know what I'm saying, hits a rabbit, it will explode, right? That's kind of the mentality. All right, so let's keep rocking on this. As a result, Herman Mark Schwartz explains in his increasingly polarized economy in the previous Fordist era, the most profitable firms were also the large capital spenders and employers. Today, by contrast, the profits are sequestered in a handful of companies, asset-light, low headcount superstar firms, which have a few internal opportunities to reinvest these profits. Which have few internal opportunities to reinvest these profits. Capital and labor-intensive firms, on the other hand, are often cut off from profits and therefore investment capital as well. Many superstar firms are also monopolies or near monopolies. As such, they face limited competition and thus have fewer incentives to invest and take risk. Over time, many industrial sectors were effectively abandoned in the United States, and production migrated to Asia, where manufacturing could still attract capital. Meanwhile, a growing portion of the U.S. labor force has been relegated to low-quality jobs. Workers have been confined to low-margin, low-growth firms. God damn, man. Listen, like, yo, I love being right. At bottom, this strategy is the Nikefication or the disaggregation of production is not primarily a strategy for maximizing growth or profits, but rather the sequestration of rents via the separation of revenues as far as possible from capital, labor, and other costs. And it is, in other words, principally a strategy for maximizing valuation of those rents. The economic discipline has still not caught up with this shift. In theory, the strong cash flows of superstar firms should have been redeployed in new investments. In practice, the process of Nikefication actually pushes most firms in the opposite direction. As a firm increases its returns on capital, its hurdle rates on new investments are likely to rise. As the firm seeks to avoid low return projects or acquisitions that would harm valuation, especially since competitors are likely improving their capital efficiency metrics as well. Yo, we've already kind of like fucking broke most of this shit down, right? Like, to begin with. As Jeremy Siegel has pointed out, companies that distribute their cash flows to shareholders typically generate better financial returns than firms that reinvest. Even if the latter grow more over time, an increasingly powerful and sophisticated institutional investor base is not aware of this fact and has a strong preference for cash distributions or buybacks, thus maintaining upward pressure on hurdle rates. Economists, on the other hand, have never internalized Siegel's findings, which clearly suggests that theories which apply from profit maximizing firms may not translate perfectly to shareholder return maximizing or valuation maximizing firms. And what are the shareholders to do with these cash returns? Economic theory insists that they will allocate capital to firms that need it. But since much of the economy has been organized around the principles of separating profits from capital and labor costs, any remaining capital-intensive firms are likely to be low return, low growth, high risk, and highly cyclical businesses, unlikely to attract much growth. Guided by the financial industry, bidding up on the prices of superstar firms or other financial assets often seems to be the only option. You want to break any of that
So
down?
now you're seeing why the fuck I was insistent that you talk about this.
You're not wrong. You're not wrong, bro.
Right. So basically what this is saying is that, like, the academic theory has been for a long time that if you just return profits to shareholders, then they're going to figure out what to do with those profits and give them to the companies that need them the most, because they're going to be because a company that needs a lot of money is going to be paying a lot of money to be loaned money, right? However, what's happening is that the the companies that need money, that are screaming out for investment, are these companies that need a
Yo, you there? All right, man. Listen. I think we're hitting that point where like motherfucking, you know what I mean? I think like, you know, like I don't have any internet at the second, maybe. I don't know. You know what I mean? Legit. Anyway, right, we're going to keep reading. The decline of value investing in the new economy. Perhaps Summers' most unintentionally revealing claim in his defense of the status quo is his assertion that value stocks, companies with relatively low valuation multiples, right, have historically outperformed the market, thus suggesting that shareholders still seek out long-term, conventional, attractive investment opportunities. All this claim still may be true over an extremely long horizon, is no longer the case over the past 25 years. In that time, growth stocks have dramatically outperformed value, particularly since the financial crisis. Value funds have returned 624% from 1995 to 2020, while growth funds have returned 1,072% over the same period. According to the Financial Times, this shift has indicated that the fundamental changes that have taken place in the economy, and it's worth taking a short detour to explain these developments more fully. You back, TK?
Here you now. You dropped for a second.
Yeah, I know. I was like, oh, you know what, man? I'll just keep reading for a second. I apologize. You know, my internet's going to go in and out a little bit here for a little. I'm sorry.
You're good. You're good.
So, you know, all right. Traditionally, value stocks were said to offer a margin of safety because of their low prices, ensured high earnings and free cash flow yields, and/or strong asset coverage. By contrast, the prices of high-flying growth stocks embedded optimistic assumptions about such companies. The ability to increase revenues and earnings if an economic downturn or some other event threatened those assumptions. However, then growth stocks could suddenly derate from a high multiple on an aggressive earnings forecast to a low multiple on a optimistic forecast. In theory, then, the value stocks afforded higher upside and lower downside because they embedded only modest expectations, implying lower risk of a multiple compression and earnings disappointments. As the famed value investor Seth Klarman put it in 1991, the most beneficial time to be an investor is when the market is failing. Value investors invest with a margin of safety that protects them from large losses in declining markets. All right, so the mentality is, right, that basically companies that stand here and do stock buybacks, you know what I mean, and like fucking are more worried about like what their fucking equity values are, you know what I mean, will continue to grow during a downturn, right? So like while we've experienced a whole bunch of downturns and we've experienced a whole bunch of time where like, you know, the fucking market has been all fucked up and the economy's been all types of screwed up, we've had, you know, I mean, these companies continue to perform well because like, you know, they're not relying upon manufacturing or, you know, I mean, fucking, you know, labor or anything of this nature. They just keep on performing with in the market itself. You know what I'm saying? Their stocks continue to fucking hold up. So these are the companies that continue to sit here and motherfucking have the ability to, you know what I mean, you know what I mean, like do what they do. You know what I mean? And that's kind of the mental as far as shit's really concerned, right? And so, you know what I mean, these are the stocks that continue to get, you know what I'm saying, motherfucking, that continue to have like individuals, you know what I mean, sit here and actually invest in them long term, right? Which drives them up even fucking more. So let's keep rocking. Today, however, the opposite is true. Value has underperformed growth in the last 2 recessions. All through value stocks have suffered lower multiple compression than growth stocks in recent downturn. This is more than offset by sleeper earnings declines. Value stocks now tend to outperform growth during more exuberant periods if they outperform them if they outperform at all. Inserting value investor dogma in short, while it may still be possible for stock pickers to achieve outperformance through superior stock market timing, i.e., anticipating macro rotations in and out of value, in any margin of safety has disappeared, and market timing is empathetically not what value investors claim to be doing. You there? You back, TK, nigga?
Yeah. I'm trying to figure out where you're at.
I think third paragraph, fourth paragraph is where I just got done motherfucking reading. Right, so I'm fifth one. Right. So I already went through some of this. I said, like, so basically the principle is that even through an economic downtime, these companies that don't have any manufacturing, they don't have any like actual fucking base, they have no fucking like people or whatever it is to worry about, they're gonna outperform, like normal growth stocks and shit, because of the fact that, like, they're not tied to, the actual like fucking country or the nation itself. It's kind of the mentality. So they're going to actually sit here and, continue to be invested in when companies like Walmart or blue chip stocks will motherfucking fail. It's kind of the mentality. I think I'm right there.
You're not wrong. But however, that assumes that those investments are eventually going to, come back up, right?
Mm.
Whereas, like, the ideology of value investing is that even if the bottom falls out of the whole fucking market, that you still have assets backing whatever you're investing in. However, like that ideology doesn't work out when anytime the market eats a dick, it just gets bailed out.
Got you. All right. So, all right. Let me get to this paragraph, and then we can keep going. This narrative, however, is a self-serving excuse that obscures a harsher reality. In truth, intrinsic values are the platonic forms of the financial world. This may or may not be philosophical defensible, but they are meaningful only because they differ from material reality. Whether or not a stock trades below its hypothesized intrinsic value has to do with minimized downside risk, because failing investments cannot be sold to Excel models. Likewise, the fact that discounted cash flows models produce different intrinsic valuations under different interest rate regimes is not the reason value investors are struggling. So, I'm guessing like the value investors, are going to be value investors are going to be individuals who, are investing in companies that are actually like fucking have some type of value, right? And offer dividends and things of this nature. Am I correct?
Yes, and they also tend to actually make things. Like I was saying earlier, the number one value investing stock over the last 20 years has been a tobacco company.
Oh, shit. Yeah, fucking because like they're actual motherfucking, whatchamacallit. They're an actual company, and they actually produce something.
Right, and like, no matter what's going to happen, people are going to keep smoking.
You're not wrong. Shit. All right, so let's keep rocking. In reality, low prices create margins of safety only if the underlying cash flows are secure. No matter how low a company's valuation multiple is, it will provide no margin of safety if its cash flow evaporates in a downturn. After Nike vacation, however, hypercyclical over-levered or other highly vulnerable companies are virtually all that's available for value investors, and virtually all that ever can be under economic order. In 2020, 20% of large public companies in the United States became zombie corporations. Again, this matches the finding of empirical analysis. Lower multiple compressions versus stock growth can be offset by deeper earnings deteriorations. The fundamental problem for value investors is that an economy organized around maximizing asset values independent of operating cash flows is essentially one that is organized around a systemic elimination of any margins of safeties achieved through low valuations. For a company to trade at a low valuation today, i.e., one that is attracted to value investors, it must not only be out of fashion or have limited growth potential, it must also have no remaining capacity for value enhancing. Financial engineering, e.g., adding leverage, increasing buybacks, or spinning out high quality business units at a higher multiple. Otherwise, management would already be doing these things to prevent it from trading as a value stock. Often, low price companies are the discarded, over indebted, zombified victims of previous rounds of financial engineering or highly cyclical stocks like certain commodity companies. Either way, such companies will not offer any margin of safety, irrespective of price. Perhaps they could still grow profits with more investment, but by definition, their returns would not meet the high hurdle rates of growth companies or venture capital, so they are unlikely to attract any new capital. Existing investors, meanwhile, still prefer shareholders' returns over earnings reinvestment. As a result, these companies will effectively trade like stocks in bad times and bonds in good times, the opposite of how value investing is supposed to work. This is true across asset classes and would even be true if interest rates rose because these dynamics are built in the firm behavior. They are not merely effects of monetary policy. Man, listen, that was a lot, but like fucking, I think this is what you were talking about earlier, right? When they were standing here talking about how like company or actually you were starting this off like when you cut off, fucking you were talking about how like companies that need investment have a hard time getting it. Ain't that about it? Where we are right now?
Yeah, yeah, that's part of it. Where like it takes a lot of fucking money to open up a coal mine or an aluminum mine or something like that. So you need a lot of money pouring into that. And it's more or less a guaranteed investment, right? Like if you buy a mine, you've got the rock, right? Like you just need to pull it out of the ground. But the issue is that you if you're pulling rocks out of the ground, you're not going to get 100 times price to earnings because like you're just pulling rocks out of the ground. You're not selling NFTs to people.
Yeah, that's fucking crazy. You want to read the next paragraph?
All right. On the other hand, most defensive stocks today are the big tech giants, which increasingly trade in line with treasuries during downturns and exhibit volatility similar to classically defensive sectors like utilities or consumer staples. Of course, their margins of safety do not arise from low valuations, but from their monopoly positions, strong intellectual property rents, and relatively low capital intensity. Although still called tech stocks and commonly perceived as dynamic companies, their cash flows are relatively secure, and they do not need to take serious risks with substantial portions of their capital. More capital intensive tech companies like Tesla still exhibit classic growth stock characteristics and volatility, but true value opportunities are few and far between. And even if one happens to emerge from time to time, there are still not enough of these investments to fill an institutional portfolio or to drive aggregate returns. Thus, as long as firm behaviors remain within the current paradigm, the value investing approach will appear increasingly obsolete. So this basically means that so long as we keep investing like we are, we're not going to be getting companies that actually provide any sort of actual value, not just to us as a society, but also to like consumers. The most celebrated value investor in history is now a former value investor. Warren Buffett evidently saw the writing on the wall early and shifted to a strategy focused on identifying monopolies or companies with economic moats a few decades ago. Others pivoted to activist investing. Value pursuits like Claremont, however, have posted weak returns for years, now seem to underperform in good times and in bad, and appear either unwilling or unable to recognize the structural shifts that have occurred in the world around them. The larger point, though, contra summers, is that the reversal of value and growth investment performance in recent decades indicates that profound changes have occurred in the operations of firms and financial markets. The relationship between value and growth performance has shifted because firm growth and asset value maximization has been severed. Basically, this is saying that the reason why value and growth stocks don't act like value and growth stocks used to is because the relationship between growth and asset value is just not there anymore.
Right. I mean, like, it's crazy that, you know what I'm saying, like Warren Buffett is just kind of like investing in motherfucking like monopolies. I mean, it makes sense though in the end of the day. Right?
Yeah.
My God, it's
like, what do you expect the dude to do? Like, you trade the market you have, not the market you want.
I feel you. I feel you. You know what I mean? But I feel like individuals should be like more speaking out about this. Well, we are, but like we're not. This is a good start. You know what I mean? Like to have like actual evidence for shit. You know what I mean? Like it's the mentality that, you know what I'm saying, like fucking the fucking stock price is far more important than whether or not your company's actually financially motherfucking solvent and shit. You know, it's fucking retarded. All right. The Asian development model versus U.S. asset and value maximization. Perhaps the clearest understanding of the U.S. economy is found in China, where officials around the media speak directly about America's increasing dependence on a high asset valuation as opposed to growth in the real economy. China, they say, does the opposite at the very least. China recognizes that these two outcomes are not the same, while American economists and policymakers assume that they are. A common summation of the difference between U.S. and Chinese economies, per Michael Pettis, is that the United States GDP is an output, whereas China, it is an input. In other words, China sets a GDP target and manages the economy to meet it. This formulation may be accurate, but it does not adequately capture the most important issue at stake. Namely, China manages its economy to optimize growth, while the United States manages its economy to maximize asset values and the private sector returns on capital. China, therefore, has continued to maintain high investment even with lower returns to support relatively high growth. The United States, on the other hand, has been content to allow investment to decline and growth to stagnate as long as the asset values and shareholder return remain acceptable. I really do think this is 99% about the fucking 401ks and like making sure individuals can retire. You know what I'm saying?
Yeah, and also the fact that like since the way we have like these pension plans set up is that they're all hooked into the stock market and shit. That means that in order to actually pay for all of these pensions, these policymakers need all of these asset values to go up, or else they can't pay for all of the gibs they have promised to all these state workers.
Yeah. Like you're like it's fucking bananas. You know what I'm saying? That like this is, you know what I mean, like fucking the reality of shit. You know what I mean? Like we've literally like this is actually us trading away our economy for the fucking boomers. That's really what this is. So all right, let's fucking. I'll tell you what, man, because we're at like an hour and a fucking 40 minutes at this point. You know what I mean? We're gonna go about another 20, and then I'm gonna have to fucking like, yo, that's enough. You know what I mean? Like, yo, I think 2 hours is plenty long enough for this motherfucker, and we fucking try to come back to this. You know what I mean? Like, fucking maybe tomorrow or the next day or some shit. So, all right. These different approaches are not confined.
I didn't figure we'd get through this in one clip.
Yo, like, I'm trying, nigga. We trying, right? The different approaches are not confined to government policies. They also manifest in private sector's firms' behavior. While American corporations and financial investors tend to be obsessed with high hurdle rates and return on capital metrics, Chinese firms give these metrics much less weight in capital spending decisions. Research suggests that this is true across other East Asian business cultures as well. Anecdotally, I have heard accounts of a meeting in which American hedge fund manager asked the head of a large Asian company what the conglomerate was doing to maximize its return on equity. The response was that some analysts in the company's insurance division looked at return on equity numbers when analyzing other companies, but he said that the industrial executives did not consider return on equity in managing the firm. American hedge funds may be appalled by this response, but most Asian companies simply do not ration capital to optimize shareholder returns in the way U.S. firms do. Or to slightly rephase Michael Pettis' analysis, America and the West views capital as the dearest input whose efficiency must be relentlessly maximized. China and East Asia views capital as its cheapest input. This is why the East Asian development model interacts so powerfully with American capitalism. Each system maximizes different variables, and in ways that seem highly complementary with the other. In practice, this means Chinese firms are almost always willing to invest with lower return expectations. The costs may not always be borne by the Chinese private sector. They may be offset by state subsidies and factors like labor and regulatory arbitrage, as well as currency manipulation, and may be at play, but on the whole, China is willing to accept lower returns in exchange for market share growth, and perhaps even more importantly, to invest in capital-intensive sectors eschewed by valuation maximizing. Western firms and investors, the outcomes, valuation maximizing Western firms and investors. The outcome in the eyes of both sides is a virtuous cycle. As China invests in, say, manufacturing sectors beneath U.S. hurdle rates, returns in those sectors and consumer prices decline, making American firms all the more eager to outsource those functions. China increases growth and investment, American firms improve their return on capital metrics and boost their stock prices, benefiting from Chinese subsidies. On paper, everybody wins. The only downside is expanding trade and capital imbalances. And although the resulting foreign capital inflows reduce the cost of capital in the United States, American corporations retain high hurdle rates and remain net lenders, inflating financial asset bubbles. And I'd like to also add into there the American workers getting fucked in through all of that mentality too.
Yeah, but like you gotta understand that these people are academics. Like this dude, I like his ideology because like this dude graduated in 2008.
That was a rough year. That was a rough year to graduate.
Yeah, but you know what business he went into?
What?
Capital restructurement.
Well, I mean, that's not a bad business to go into in 2008.
Right. So like he personally benefited from it, but he also got to see like all the consequences from that having happened. And so like he's definitely a more he's a more academic individual than either of us, because this dude went to Harvard, but he also went to Harvard because he admired Alexander Hamilton. So he's remotely a dude who like cares about America.
All right. So, all right, let's get to this next one, because we're actually going to get into, the mentality that I'd like to get into. Perhaps because shareholder primacy theories had prepared businesses, executives, and politicians to believe that increasing returns on capital was always synonymous with increasing growth and productivity, and because they were generating tremendous wealth from offshoring U.S. elites, were quick to conclude that the deindustrialization of America was simply the loss of commodity manufacturing. But that was never entirely true because the sectors lost were determined by their financial characteristics, not their technological significance. American firms happily shed telecom equipment manufacturing, for example, to pursue higher return businesses. Yet, as both the U.S. national security and business communities have since discovered, many enterprises that might trade at low valuation can still have great value, and many commodity businesses can prove shockingly difficult to replace. While U.S. firms were shedding competencies to inflate asset values, China was building industrial and innovation capacity. Today, Apple pays Huawei to license its 5G patents. That is fucking retarded. Legit.
Yep.
Why is Apple paying motherfucking Huawei to license its 5G patents?
Because some American company sold its 5G IP to Huawei as a basic thing here. And by the way, that's something you really should be concerned about, not because like, oh, 5G, it's making the COVIDs or whatever the fuck it is. I love you, Mike. I'm not making fun of you. But like, because 5G technology is missile tracking technology. That's remotely something we should be concerned about.
Well, I'll be honest with you. You know what I'm saying? Like, I know dick about 5G, right? Like, Mike keeps trying to explain that shit to me. You know what I'm saying? But, like, I'll be over here like, man, listen. Like, yo, I can't get on that level with you about the, you know what I mean? Like, the 5G making the oxygen molecule motherfucking rotating on this motherfucking axis and shit. You know what I mean? Allowing individuals to become motherfucking, you know what I mean? Like, drones and whatnot of the motherfucking New World Order niggas and shit. Like, I can't get down with that at the moment. You know what I mean? But like, yo, it is what it is.
5G is just what your microwave makes.
That's still like I don't trust my microwave. You know what I mean? I'm gonna be real with you. I don't trust that shit. I never trust a microwave. Like, but that was when I was a little kid and shit. You know. Got to remember, most of this technology is kind of, you know, it's something that I like. It wasn't around when I was born, right? Most of this shit wasn't there when I was a kid, right? So like, you know, fucking like when I was a pup, we got our first microwave. We covered it with a blanket and shit, right? Because we were scared it was going to irradiate us all. You know what I mean? We're such savages. Anyway, Western analysts skeptical of the Chinese growth model insisted it's unsustainable, a claim they've been making for some time, though talk of democratization and China's inability to innovate has mostly faded. But their arguments increasingly evoke a dark irony. All the problems that are supposed to make China's model unsustainable are at least equally present in the United States. Perhaps China's model cannot last forever, but it does not have to. It only needs to outlast its competitors. Yo, that's a good point. Like, you always hear motherfuckers talking about motherfucking China's gonna fail, you know what I mean, as far as like how its shit works. But like, we just watched them go through like a major motherfucking thing and like they're still like chilling, like it ain't shit.
Yeah. I mean, the only problem that China has is that like it's impossible to get energy products in there unless you have a massive fuck off navy.
Well, like with the whole what was it, motherfucking Evergrande, wasn't it? Motherfucking the bank or whatever it is.
Yeah. And from what I can tell,
and China was just like fuck it, we don't care. You know what I mean? Like, you let housing prices drop. That's probably good for our citizens. Like, oh, wow, that's fucking amazing. like we're not bailing this bank out. Like, fuck that bank. You know what I mean? Like, y'all motherfuckers, if you invested, you're fucking dumb. You know what I mean? Like, yo, you motherfuckers paid a price for fucking investing in stupid shit. And these motherfuckers acting like retards. Like, but you think this is going to last forever? And it fucking failed. And like, China was just like, we don't fucking care. You know what I mean? They just keep going.
Evergrande actually has been making its payments, and it seems like it's because like the owner has been through one method or another convinced to like sell his assets to keep the company afloat.
Fuck it. You know what I mean? Like, yo, maybe, just maybe, you know what I mean? Like, you know, fucking, like, this is not a bad business model to have. Like, yo, the owner of the company or the fucking CEO or whatever, or the shareholders or the stock or just fucking, you know, the chairman of the, or the fucking, what is it, the goddamn shit, man. The council, the fucking people who sit on the motherfucking table, the board members should be the motherfuckers responsible in the end of the day. You know what I mean?
Yeah, and I'm gonna be real here. I've never known a business owner that I respected who has not put like payroll on their own personal credit card.
Yeah, I feel you. But like, you know, these CEOs in America, they would never do that shit.
I mean, not the big firms, no. I've known a couple people who are running like grocery stores, machine shops, butcher shops, that type of thing that'll do that.
Yeah. Like I know construction guys or fucking HVAC guys who have done this with their crew. You know what I mean? Mechanics, fucking people who own like auto shops or whatever it is. I've known them dudes to do it. You know what I mean? You know, fucking like it is what it is. But anyway, like fucking, that's kind of the mentality. Like fucking, I would love to see the CEOs held accountable for their fucking dumb bullshit actions. You know what I mean? All right,
I mean, isn't that why they're getting paid so fucking much?
it's
Because they're
supposed to be.
responsible for.
It's supposed to be, right? It's supposed to be, right? You know what I mean? Like that's how it's supposed to work, but it's not actually working. You know what I mean? So, all right. If China is threatened by high debt levels, so is the United States. If China had to issue more debt to maintain growth, the Fed has had to buy more debt to maintain its asset values without growth. China's productivity may be slowing, but America's has been weak for years. China's inequality may be rising, but America's is still worse. And whereas the Chinese have enjoyed unprecedented improvements in living standards over the last few decades, American millennials are expected to be the first generation in U.S. history to end up poorer than their parents. American foreign policy bloggers speculate about whether China might become more belligerent if the Communist Party faces internal pressure. Chinese analysts reasonably ask the same question about what America might do if the public trust in its institutions hits all-time lows. I think we've been there, haven't we?
Yeah, yeah. It says as public trust in its institutions is in its all-time lows
Yeah, I mean, like,
as it hits them.
yeah, but I'm saying they're asking
Like we're
might
already there.
Chinese might reasonably ask the same questions about what might America do as in trust into as public trust in institutions its all time lows. Like, man, listen, you know, what I mean, like, yo, fucking, like, we're all figuring that out as we go right now. No, what they're gonna do is the
Yeah,
CIA and
yeah.
the institutions are gonna buy advertising on the motherfucking news and you know what I'm saying, like media companies, in order to try and like reinstill motherfucker. They're gonna spread propaganda the way they always do. You know what I mean? That's how America works. They fucking spread propaganda to like get you behind their bullshit. You know what I mean? That's what the fuck they do. Anyway, with China now the largest economy in the world by purchasing power parity, talk of a new Cold War is intensified, but the analogy does not hold. When America's CEO described their companies as brands and of China for China, fucking there is no Cold War. America's entertainment industry is far more solicitous of Chinese public opinion than its own country's. Nor is it possible to ignore the fact that American oligarchs like Elon Musk treat the U.S. government with visible disdain, but render Chinese authorities the utmost obedience. While the old script about human rights is still being recited, America's presumed allies have made it clear that the performance will not be allowed to interfere with their economic partnerships with China. They're like, yo, man, listen, like, yo, fuck your feelings. We about this money. That's kind of the mentality, right? He said there is no Cold War under such circumstances. Cold Wars are led by states. In the American states, it's subordinates to a comprador oligarchy. This class, the motherfucking cathedral, son. The class is deeply reliant on China, some directly for contact manufacturing, more directly to maintain a high asset values. China could destroy many leading U.S. firms and fortunes overnight, and has shown no hesitancy to do so with its own tech companies. U.S. oligarchs will not tolerate such costs. However, America has already imposed most of the trade controls on China that it realistically can. To seriously confront China, the U.S. state would first have to gain supremacy over the oligarchs. But if the state were strong enough to do that, the current situation would not have arisen in the first place, and a reasonable settlement with China could probably be negotiated. Yo, they're not wrong.
Yeah, yeah. The problem isn't China. It's that we've got an oligarchy here in America that needs China to keep its power, and so it will do whatever the fuck China says.
like it's fucking crazy. You know what I mean? They're like these companies are that dependent on a foreign nation, you know what I mean, for their bullshit. And like people warned about this shit happening and like we've been speaking about it forever, you know what I mean, whatever. But like every time I talk to somebody who is, you know what I'm saying, like of the working class, who's just like a normal fucking person, they're all like, well, international trade is good. And I'm like, you dumb motherfucker. This is the end result of international trade. This is what happens. You end up completely relying upon shit. And especially in a fucking government where you don't have control over, you know what I mean, any of the fucking institutions and shit. You know what I mean?
100%. Like the only reason why the American government ever listened to the people was because, like, number one, it is America is fundamentally an ungovernable landmass. Like there's just too much area. There's no choke points. You can't figure it out unless you artificially set up a network and then control that network. Internet. Um, but but the only reason why the government has in the past listened to like the common working man is because like there's just been so many resources out there that could be alternatively used that like there's no bottleneck to make all of the workers do what you want them to do. That's why the oligarchy absolutely loves international trade, because that means you just control the ports and you control everything.
That's goddamn crazy and shit. All right, we're gonna read this last paragraph and then we're gonna fucking shut it down. All right, Branko Milanovic has described the American and Chinese system as liberal meritocratic capitalism and political capitalism, respectively. Milanovic's terminology is useful that it reveals the paradox at the heart of the contemporary capitalism. For capitalism to remain oriented toward growth and to live up to its Smithian justification, the private sector must be subordinate and take direction from the state. In liberal capitalism or plutocracy, on the other hand, the oligarchs will use their power to resist development. For them, hoarding capital to preserve high returns and asset values is preferable to investing in growth at lower returns, if not always on an absolute basis, then at least relative to the rest of society. Yeah. And I mean, and I hate, like, I don't want it to be a fucking class struggle, Marxian motherfucking, you know what I mean, Leninist type of ideology. But, like, that's what you come fucking back around to in full fucking circle and shit. You know what I mean?
Yeah, yeah. The main difference here is that, like, we, if we want to be like, Marx wasn't wrong in a lot of his criticisms. He just didn't have the right solution in a lot of cases. And there's also the fact that like Karl Marx wasn't a Marxist.
I feel you. I feel you. Like, the modern day Marxists are way, way worse. Right. I mean, it's kind of like that argument of, you know what I'm saying, like the gay man pile on South Park versus, you know what I mean, like fucking singing fucking songs and doing kumbaya and hippie shit where you're fucking planting trees and cleaning up fucking garbage and, you know what I mean, like fucking, it's all types of like fucking multiracial, multi-ethnic fucking, you know what I mean, diversity bullshit. Like, I think I'll go back to the man pile. You know what I mean? And it's, there's got to be a better way, legit. You know what I mean? And I think there's a way to do it that makes way more sense. You know what I mean? Like, maybe we reinstall fucking Glass-Steagall. Maybe, you know what I mean, you stand here and you get rid of a lot of like the Reagan reforms as far as like, you know, fucking where capital can motherfucking fly to and like where, you know what I mean, like fucking you have more economic fucking activity inside of this fucking country instead of out of it. And we take away the ability for places.
Capital controls.
Yeah, capital controls. We need capital controls, like as a whole. You know what I mean? Not so much on the level like you can't earn this much money. Like, I don't give a fuck how rich somebody becomes. Like, we can create another Rockefeller or fucking, you know, goddamn fucking JP Morgan for all I care. I don't really give a fuck about that. But my mentality is that if you're going to make that goddamn money, it's going to be here. You know what I mean? It's going to be off the backs of our fucking people. And I have no issue with that whatsoever. You know, that's kind of my mentality.
Right. And the issue here is that like business is so geared towards this way of doing things that, like you were saying earlier, or you've said in the past, like if people actually had to pay Americans to do the work needed to get the shit that they use every day, like prices would be so high that people would be rioting in the streets.
Well, you know, I mean, it's the issue of like the Fed has destroyed our motherfucking currency. You know what I mean? And the fact that we have these, you know what I mean, fucking systems where they can go to Asia for manufacturing or, you know what I mean, fucking whatever, it destroys or it fucking hides the fact of what the Fed has motherfucking done. You know what I mean? And that's kind of the mentality as a whole.
Yeah. Although they're pointing out here that like the Fed, while an issue, you can't credit the Fed for just gutting these companies because it's the investors and the shareholders who have been asking for this gutting.
Well, it's not about the Fed gutting these companies, right? It's about the Fed who has, and like here's my mentality. Like I want to show like the American people the truth of like how far we've fallen, right? And the way to do that is to like stop these companies from fucking, you know what I mean, like stop the capital flight like across the, you know what I mean, inside the United States, and force these individuals to be able or force these companies to invest in America and hire Americans. And if you do that, if you close the borders, you know what I'm saying, like you're going to watch the cost of goods jump immensely because of the fact that you no longer have the ability of, you know what I'm saying, like the fucking of them to be able to like use cheaper labor and shit. They don't have slaves. You know what I mean? And if they don't have slaves, then you see like, oh, our dollar really isn't that valuable. And that's the truth. It's not the fact that, all right, like everybody goes like, oh man, like a TV used to be $1,000 or $10,000 or whatever. A fucking computer used to be $2,000 and now it's fucking like $200. I'm like, that's not a result of, you know what I'm saying, technological efficiency. That's a result of, you know what I mean, like offshoring a motherfucking labor costs and slavery motherfucking building and fucking assembling it. It's kind of the deal.
Right. Like if you had to build a computer here, that then they would still cost about the same amount that they did in the 1980s. And back then, like computers cost more than cars.
Yeah. I mean, and like the cottage industry that would popping up for individuals having to fix the old shit because motherfuckers couldn't afford the new shit would be fucking massive. You know what I mean? But anyway, yo, look, man, we're at 2 hours, so we're going to cut this motherfucker here. We're at like 2:01 at the moment. You know what I mean? Like, yo, it is what it is. Y'all know the deal. Like, share, and subscribe for anybody that made it the whole way through. Thank you for motherfucking listening to us motherfucking talk about what we talk about. Hope y'all enjoy. You know what I mean? You know, that's where we are at the moment. You know what I mean? Got anything else to say, my brother TK?
Read American Affairs Journal, like as an in general thing. Like I don't agree with everything what these guys say, but like they're on a different fucking level.
I'm going to drop a link in the description for everybody so y'all can motherfucking check it out. Thank you, my brother, for coming through. Thank you for your motherfucking donation to get me to do this. You know what I'm saying? It's most definitely been enjoyable. I'm going to fucking upload this, work on this cartoon. Man, listen, it's going to be done tonight, my brother.
Nice.
Hell yeah. I'm looking forward to it. All right, everybody. Peace be like one, motherfuckers. Later.